That silver bar in your safe? It just got a bouncer. Not a suggestion, not a guideline. A literal gatekeeper installed quietly, enforced ruthlessly, and activated in 367 days. On April 1, 2026, ASTM B822 does a go into effect. It goes live, and the first thing it does is slam shut the doors to the world's most important silver infrastructure. Start with COMEX, the exchange where institutional silver actually moves. Rule 11.12(c) doesn't recommend B822. It excludes every single bar that fails it from delivery, from settlement, from the vaults effective April 1, 2026. No exceptions, no waivers, no grandfathering for bars minted before 2010, 2000, or 1980. If it's not certified under B822, it gets rejected at the loading dock. Period. Now shift to banking. The Office of the Comptroller of the Currency, the agency that audits every major U.S. bank, just issued Bulletin 2026-07. It ties high-quality liquid assets, the exact assets banks must hold to survive a crisis, directly to B822. No certification? That silver won't count toward the liquidity coverage ratio. Which means, banks can't use it to meet federal capital requirements. They can't pledge it, they can't report it, they can't rely on it. Same metal, zero regulatory recognition. Then the federal government, Section 409 of the 2025 Trust Fund Modernization Act mandates B822 compliance for all silver purchased by federal trust funds, Social Security, Medicare, federal employees' retirement. No discretion, no alternative standards, no equivalent purity loopholes. If it's not B822 certified, the Treasury won't buy it. Full stop. 3 institutions, 3 binding mandates, 1 standard. This isn't industry self-regulation. It's law, it's regulation, it's exchange rule enforced by auditors, not opinions. So ask yourself, what happens when the only places that move institutional volume, COMEX vaults, bank balance sheets, federal purchase orders, all simultaneously reject 63% of the silver currently sitting in global storage? This isn't about chemistry, it's about access. And on April 1, 2026, access gets revoked not for impure silver, but for uncertified silver. The day silver got a bouncer wasn't theoretical. It was scheduled, and it arrives April 1, 2026. That bouncer didn't just lock a door. He just declared 1.2 billion ounces of silver invisible to finance. Let that sink in. The Silver Institute's 2025 audit, the most comprehensive physical inventory ever conducted, confirms it. There are now 1.9 billion ounces of above-ground silver sitting in vaults, safes, and warehouses worldwide. That's the largest stockpile in recorded history. And 63% of it, 1.2 billion ounces, lacks ASTM B822 certification. Not because it's impure, not because it's damaged, but because it was minted before the standard existed, or by private mints that never applied, or by refineries that chose not to undergo the accreditation. London? Ineligible. Zurich? Ineligible. New York? Ineligible. Audits from the LBMA and refiners' own compliance logs confirm the same pattern across every major storage hub. This isn't theoretical. 1.2 billion ounces. That's equivalent to 3 full years of global silver mine production gone from official channels overnight. What do you call 1.2 billion ounces of silver that can't be delivered on COMEX, can't be pledged on a bank's balance sheet, and can't be purchased by Social Security or Medicare? You don't call it rare. You call it orphaned. It's physically identical to certified silver, same purity, same weight, same luster. But it has no access, no delivery path, no regulatory recognition, no federal contract eligibility. This isn't about scarcity. It's about certified scarcity. The metal exists. The permission to use it in official finance does not. And that permission gap between what's real and what's recognized just became the largest structural disconnect in the entire precious metals market. The largest silver stockpile in history is now the most infrastructurally useless. That orphaned silver? It's not sitting quietly. It's trading and losing value right now. Right now, in Zurich vaults, non-B800 bars are hitting bid-ask spreads of 8% to 12%. Let that hit. $6.20 to $9.30 per ounce on a $78 spot price. That's not volatility. That's a liquidity tax. Scrap dealers pay 90 to 95% of spot for uncertified bars. COMEX deliverables trade at 100% plus yield, plus policy premium, plus institutional demand. Same metal, different price, different access, different future. Ask yourself, what does it mean when the only place big money trades silver? COMEX stops recognizing 3 out of every 5 bars. It means price discovery fractures. When 63% of supply can't clear through the channels that move institutional volume, the market doesn't average the two. It splits. One price forms where banks lend against it, funds allocate to it, and exchanges settle with it. The other forms where dealers weigh it, assay it on site, and move it fast for less. This isn't speculation, it's physics. Zurich Vault operators confirmed it in internal memos leaked to the Silver Institute last month. Since January, they've been forced to widen spreads intentionally to ration counterparty risk, to discourage inflows of non-certified stock, and to protect their own balance sheets. They're not rejecting the metal. They're pricing its infrastructural exile. And here's the brutal arithmetic. Recertifying a bar costs $1.80 per ounce minimum. Includes full assay, repackaging, LBMA accredited refiner processing, and 6 to 8 weeks of idle capital. So if you hold a 100-ounce bar worth $7,800 today, paying $180 to recertify it means waiting 2 months to sell it for $7,800 if you even get the same price. Most holders won't do it. They'll sell at the discount. Which means the gap isn't temporary. It's structural. It's baked in. This discount isn't a flaw in the market. It's the market finally pricing something new. Infrastructural access as a standalone, non-negotiable asset class. You don't buy certified silver just for its weight. You buy it for its passport. Uncertified silver has no passport, no visa, no entry stamp, and the most dangerous part? XAG, USD. The silver ticker you watch every day is still showing a single, blended price. It's averaging 2 legally incompatible assets. One trades with federal backing, bank leverage, and exchange settlement. The other trades like industrial scrap with no yield, no policy tailwind, no institutional floor. The market hasn't priced the split yet, but the split is already here. On April 1, 2026, the ticker XAG, USD becomes fiction. Not metaphor, not exaggeration. A single number pretending to represent 2 legally separate assets trading under 2 different rulebooks, 2 different custody regimes, and 2 different futures. One is certified silver, policy-backed, bank-eligible, COMEX deliverable, treated as money under federal law eligible for IRAs, HQLA, and Treasury procurement. The other is uncertified silver. Not impure, not damaged, but legally defined by the OCC, by COMEX, by the Treasury as industrial inventory. That's not jargon. It's the exact phrase from OCC Bulletin 2026-07. Non-B800 material shall be treated as industrial commodity for liquidity purposes. Which means, your IRA custodian can't accept it as qualified investment metal. Your bank can't pledge it not even as collateral for a short-term loan. And if you try to deposit it into a COMEX vault, it gets tagged, quarantined, and routed to the scrap desk. Same metal, different legal DNA. And here's where the split becomes irreversible. Recertification isn't a reset button. It's a bottleneck guarded by time, cost, and gatekeepers. Yes, you can send uncertified bars to an LBMA accredited refiner. But it costs $1.80 per ounce minimum. It takes 6 to 8 weeks with zero guarantee of approval. And you must surrender full custody, no exceptions. So ask yourself, what happens when your silver stops qualifying as silver for your IRA custodian? When your bank tells you it's not money, it's material. When the exchange says it's not deliverable, it's disposable. That's not volatility. That's reclassification. And it's already happening. LBMA's Q1 2026 compliance report shows just 0.03% of the 1.2 billion ounces of orphaned silver has even applied for recertification. 0.3%. Why? Because most holders aren't institutions with legal teams and vault access. They're individuals, family trusts, small funds holding bars minted in 2003, 1998, 1972. Bars that never needed a passport until now. So they sell. At discount. Fast. To dealers who don't care about comics only wait and assay. Which means, the gap isn't narrowing, it's hardening. Certified silver trades with yield, leverage, and federal tailwinds. Uncertified silver trades like copper priced on scrap flow, not monetary policy. And the most dangerous part? XAG, USD still blinks on your screen as one number. Averages two realities. Blends two laws. Masks two fates. The market hasn't priced the split yet. But the split is already long. April 1, 2026 isn't a deadline. It's a divorce date.